Hello and welcome to this session. I'm Deepshikha Munga, an editor at DealStreetAsia, and today I'll be talking to Jenny Lee, managing partner at GGV Capital. Jenny launched GGV's first office in China in 2005 and reopened GGV's Singapore office in 2019. She's one of the top tech investors in the world and was recently named to Temasek's board. Thank you for joining us, Jenny, and welcome.
Thank you, Dishika. I'm very happy to be here.
All right. So Southeast Asia had a really strong 2021 with an accelerated digitalization spurring more investments in the region. As an investor, did you see any surprises in the way the startup ecosystem fared in the region after the pandemic outbreak?
Yeah, so I think that, as you mentioned, so GGV, we've historically been pretty much all in terms of investments in the US and China market. And in 2019, we reopened our Singapore office. And we do that because we saw opportunities in the region. And when we look at Southeast Asia, there were fundamental shifts that was happening. I think one, the talent pool definitely was getting a lot better, starting to have super unicorns emerge. And with that continuous stream of so-called trained talent who's been in one startup, maybe two startups, and now doing their own startup. So I think talent pool is always a big one. Secondly, I think markets like Indonesia, like Vietnam, also starting to show very supportive regulation and support, right, for new startups, private enterprise. So all in all, we look at this as a bit of a mid to long-term trend that these markets are emerging with the right fundamentals. And so to your earlier question, does COVID change any of this? I think COVID has only accelerated the mind share, the awareness, and also the acceptance that the new digital world is here to stay. And to do that, you actually need a different type of ecosystem, right? And that type of new model, innovative business model may have to come in the form from the startups initially. And so I would say all trending in the right direction. As this kind of pandemic evolve as well, I do see that the startup ecosystem is also adapting to it and featuring new different work formats to adapt to it. So longer term, we are optimistic, cautiously optimistic as well, but pretty bullish about the opportunities that this emerging region can bring to us.
Okay, you talked about cautious optimism. What is causing the caution with the optimism?
Yeah, so I think that if you've been following the capital market, it is a reflection of many factors, right? Capital markets is always the first. I like to tell our portfolio companies, I always said, don't look to us, the private market, look to the public market. And Mr. Market is always right. Like, no matter how you want to fault it and give it reasons, they're always right. And why are they right? They reflect the sentiments. And for whatever reason, sentiments could be perceived, could be real. Currently, we are in an era or a period where you have a lot of things that's happening. On the macro basis, inflation on a global basis. Every country is looking at inflationary pressure. What does that mean in terms of consumer spend? What does that mean in terms of currency stability? Those are already one set of questions that governments, startups, entrepreneurs, investors have to deal with. And you layer that with geopolitical tensions, right? Whether it's China, US, whether it's Russia, Ukraine, all that adds additional uncertainty to just the base market. And so I would say that with that in view, markets comes and goes. It goes in cycles. In my 22 years as a VC, I was talking with our team and we were going through the cycles. I've gone through 9 cycles of up and down. But at the end of the day, I think being consistent, being longer term viewed, since we are on the private market, we should have a longer term perspective, 3, 5, 10 years. And so in that sense, as I mentioned, directionally, we are positive, we are bullish. But I think as we navigate this broader environment, it pays definitely to be more cautious, right? And so holding the bar high, having open communication with our founders becomes very important during this period.
Okay, And amid this environment, how do you see the role of hedge funds that are starting to play in what's traditionally been venture capital territory? How have they impacted competition for deals and the impact on valuation? So, on the one hand, you see what's happening in the public markets. On the other, you also see enthusiastic investors continuing to put in a lot of money. So, what's your take on that?
Yeah, well, I think that hedge funds are here to stay, right? And so, but by design, I think hedge funds likes volatility, and therefore I do feel that they, in the short term, they are equally affected, if not more so, than the private VC and PE segment. And so, if you look at their public portfolio, and some of these numbers are public, right? The hedge funds, on average, I think hedge funds are down 50 to 90% of the value year to date. And that's just where today is March 9, right? So it's not even done with Q1. So what does that mean, right? I think that tactically, one, definitely there will be a bit of a different consideration in terms of how they play the public market, likely a pullback in terms of the public market, in terms of pre-IPO deals. And so I'm not surprised that increasingly, today we may only start to hear one or two, but increasingly you may even see hedge funds going more and more earlier into our segment. That's just facts that we have to deal with, right? As this whole market tries to digest the risk that the public and later stage and the risk that it's going to bring, then, for the same risk profile, you want to go a bit earlier. So I do expect that our peer, whether it's GGV or my other friendly VC funds and PE, we will and should expect to see more competition from the hedge funds coming in. If the competition is purely on capital, then that's where it stops, right? Then it's really capital as a model, and there shouldn't be a definition whether it's VC, PE, or even hedge funds. It's just capital, right? Whoever has the most capital wins the game. But I think that, this many years in the industry, particularly in emerging regions, founders may like capital, they want capital. But I think the smart founders want partners that who can help them navigate, who can help them see, what's going to come. As I mentioned, this global world is not getting easier. It's getting more complicated with so many factors that are beyond just a typical startup universe, right? Where you think about organization, team, strategy, profitability, business model. Now you have to think about geopolitical, you have to think about currency, stability, all the other factors. And so having the right partners whom you can call, in my view, becomes very important. And so, yes, I think competition is on. And that means we have to compete on areas beyond capital. And I think that's a challenge that I have to go out to all my peers. We got to do better than the hedge funds.
But talking just about capital, there is a difference between the active capital and passive capital that, for instance, Tiger has really is starting to make more mainstream. There is space that is sort of unmatched. I mean, it's a new SoftBank or SoftBank 2.0, if you want to call it that. Does that also change founder expectations of how they expect their investors to behave?
Yeah, so I think this is very similar to what I just talked about, right? So I think that there are all kinds of founders and startups are in different phases of their life, right? And so for founders who may already feel like they have a very strong group of investors around the table, board members around the table that they can talk to and share, then definitely having kind of passive capital may be what they are looking for, right? Because they got it done, right? They have their buddies around the table they can talk to, their consultants, their advisors, and the model is chugging along. And what they need is that extra dollar, right, to help them maybe safeguard their business, expand inorganically through M&As and stuff. And so in that sense, I think definitely there is room for passive capital. But I think, as I mentioned, when the world gets chaotic, actually the active capital becomes more important, because it's like, you have, is it better to just talk to one expert or 10? Right. And if the challenges you face is not one challenge, right, it's multi-facet, then I think having people who have done it, seen it, who can tell you, watch for ABCs, those are definitely a lot more valuable. It's going to be the difference between a company that becomes super unicorn or unicorn, the difference between a company that hits 500 million, 100 million, even a billion, right? And so how founders view that, I think you will have a range. But I think that as world gets more uncertain, the active capital becomes more important. Now, if today we are going into a world where it's just a straight line up, right, to the north, to the right, then yes, I think at the end of the day, the tide's rising, things are great, markets are biting, valuations are forward, valued 3-5 years, then I think you just need passive capital, right? Because you have a lot of room for mistakes. But in an uncertain, oscillating market where the room for mistake is very small, then I think every step matters, and therefore having the right folks around you becomes very important.
And talking about that, where does that leave smaller regional firms? So Southeast Asian VCs then have to compete with the hedge funds who have the pace and the passive capital, global fund managers who have the networks and connections. What's their advantage in all of this?
Well,
I think that choose them.
It's a great question, Dishika, because that's what I've always been saying. I think that over the last few years, when this region is not as highlighted and of a special priority, I think that our local VCs and PE members have time to learn, right? Many are into their second, third fund, 5-6 years. They're starting to see the whole cycle from investments to exit. And to be fair, I think that's the timeline that you need, right? For a VC firm to mature, for partners to have seen it all. Now, of course, the region also has very experienced investors, but in general, I think it's still a very young market for VC and PE. And so, yes, the competition they will face, it's going to be, pretty big. So I would encourage our local funds and regional funds to really adopt a syndicate mode. Right, so you want to fight a battle, you go in together. Right? Many of our funds here are not in the multi-billion space, and so I think being able to work on the deal in very tight syndicate is what we have seen. Right, in early days of China, when China venture capital market was evolving, that's what happens. Right, you have there was no tiered VCs. Right, everybody was just trying to figure out what their position in the whole ecosystem. But then it starts to emerge venture firms who actually have partners work together across the firms very well. And together they create success together. And that's learning together. Now, they also could have encountered failures together. But that success and failures together allows for bonds to be formed. And these are bonds where it's going to be extremely valuable as well, right? So when you go into bidding for a hot project, right? Or when you're all on the board and you're trying to encourage the CEO to say, go take the M&A offer and not be a public company, like there is a lot more common voice and common experience that you can share. So I think this is the time to build, partnerships, comradeships, as you call it, allies. And I think that needs to happen because that's the only way you can compete with just pure capital coming in. That you compete on the strength of your syndicate. And I think it will go a long way to actually also allowing this industry to mature. In other markets, I've seen, whether it's US or China, in mature VC markets, the VCs do work together quite a bit, right? So where you may compete on deals, because after a while, as the market evolves, in venture, you have all stages, right? You have the seed, the scouts, the seed deals going to Series A, Series B, Series C. After a while, as markets mature, you realize that there's always a deal you want to get in at Series B, whom your competitor has got in Series A. There's always a deal, that we got in at seed that our competitor wants to come in at Series A. And so after a while, it becomes a very intertwined industry. And that's when the special call happens and said, hey, let's trade, right? So this is like behind the scene, but I'm hoping the same thing would happen in Southeast Asia. I'm starting to see it, but hopefully, this call to come together would help accelerate that as well.
Okay, let's move on to IPOs. What do you make of Grab and its post-listing performance. And it's not just Grab, it's Bukalapak here in Indonesia as well. What do their performance as public companies so far? What are the implications that it has for other companies that might be looking to go public in Southeast Asia?
Yeah, so I think that when we look at, well, first of all, we are private investors, right? So again, it's very hard for us to comment specifically on one or two public companies. But I do want to say that as we started this conversation, the world is in chaos right now. The capital markets is just a reflection of this. And therefore, we have to take that into consideration, right? The whole market, as I mentioned, has had a valuation reset. Many of the great enterprise type companies in the US, the best business model you can think of, right? Software as a service, API call, recurring. Some of these leaders in the category is down 50 to 90% of their value, right? So we have to take that into context. The broader market has had a valuation reset, number one. Number two, as the world starts to deal with, as investors starts to look at risk profile by region, there is with inflationary pressure, with war on the, that's going on, there is always a pullback of capital back to the core markets where risk is perceived to be lower. In this case, likely to be in big markets like the US. And so companies in emerging markets, whether it's India, Indonesia, even China, with, potential further or the overhang from, the regulatory changes from last year, those means that there has to be an extra risk premium that's associated with that market. And so, investors, if you talk to any public investors, that's how they think, right? They think about risk adjustment on a macro level by regions and then by sectors. And so I think that in that light, it would not be fair to look at just Indonesia companies or Southeast Asia companies by themselves. I think it's important to look at the business model. It's important to look at the mid to long term. I think what's been a good sign for so many years, I think we've always been waiting for our local heroes, right? And so in the last 2 years, we start to see those local heroes. Now, my experience with public companies is this. When Tencent from China went public in Hong Kong more than, I would say, 15 years ago, right, 10, 15 years ago, their valuation went through this roller coaster because no one knew what Tencent was about. They were listed in Hong Kong. It was their first internet company there. People were like, okay, it's QQ. What's that, right? And so definitely for 2-3 years post-IPO, that valuation really went up and down. And there are two factors, right? One, the market has to learn to understand the business model. And then two, the company has to learn to be a public company, right? How do you do reporting on a quarterly basis? How do you have communication on investor relations such that you can articulate a relatively different or complex business model to international investors? And so, as VC investors, usually when our portfolio goes public, for the immediate at least 1 to 2 years, we tend to discount a lot of market movements because it is a lot of combination of factors, right? And therefore, we do need to give our public company a chance to figure out, how they do the communication. Now, the fact that they are doing this in a world that's in chaos means that the challenge is multifold, right? Bigger than usual. And therefore, I think that, we just have to make sure that there is, companies, I think CEOs have to make sure that they have the right people in place to really guide the company, over this next 2 to 3 years kind of post-IPO period.
Okay. What would your advice be to companies, private companies at the moment who might be exploring a public listing? And especially the SPAC route, what would you say to them?
Honestly, I think the IPO window is shut. It is not physically shut, but I think that right now you can go public, but most of international investors are on the sidelines. So you could be the best company ever to hit the public market, but I think that you're still going to find it really tough to get through the roadshow and to build a respectable book of demand. in many cases, if you talk to the public investors today, they are on the sidelines. They are waiting to see what will happen, given what we mentioned, all the macro factors. If anything, they are taking money off the table to de-risk their portfolio. So this is really not the best time to attempt an IPO. If you really have to go public for whatever reason, then be prepared that it's going to be a smaller IPO, a much reset valuation. And definitely you have to do more communication. If a typical IPO route is 14 days of roadshow, you may have to do like 3 weeks, 21 days, just to make sure that you have enough funnels and that you are assessing maybe non-traditional public investors. So my recommendation is definitely not the best way to be public. Being public is the start of a long journey, and you kind of want that start to be in relatively calm waters and not launch a boat, when you have thunderstorm and turbulent wave and tsunami coming. That's not the way to navigate the company. Now, whether it's a SPAC or direct listing, those are just tools to get listed. And I think that depending on the business model, certain tools may be better, right? So again, assuming we are in calm waters and it's calm time, then I think the SPAC route is ideal for companies that needs to show and talk more about future earnings, right? That means, for example, if you are spending, if you are in the space tech industry, right, sending rockets into the space, and you're saying my revenue is only going to come in 5-10 years later, right? So for stories that just needs a bit more time, a bit more forward earnings, more articulation to show the model, actually the SPAC route does allow you to do that, right? Versus a quick 7 days, 14 days IPO roadshow, show your historical numbers and then decide if you want to come in. So I think that there's benefit to exploring some of this, again, in calm times, right? Today, the SPAC route is also not an alternative. I mean, assuming IPO market is closed, the SPAC investors are also suffering from a valuation reset in the whole SPAC trading post their de-SPAC process. And so again, not the right time to attempt this. But again, in calmer times, then I think certain companies should go the SPAC route. But others companies, I think that if you are category leader, business model is well baked, a lot of good comparables in the market, then just go IPO. There's no difference.
Okay, we've talked about the caution, the choppy waters. What about the optimism? How is then Southeast Asia's tech sector entering the golden age? What is it that makes you optimistic about growth here in this region?
Yeah. So I think, as I mentioned, right, cycles are quite normal. And down cycles are actually the best time for great companies to be incubated and to be born, right? I talked about Tencent. If you look back at Alibaba, if you look back at Facebook, actually many of the great companies, even Google, were born in periods of turbulence. And what that does is actually gives them time, right? Versus trying to grow up so fast in an accelerated time frame when you're not ready, you now have a bit of time, meaning that, like as I mentioned, mid to long term, we are bullish about the sector. We're cautious in the short term. But what that means for founders is that you don't have to hurry, right? You don't have to say, let's go public before you're ready. I think right now it's very important to go back to fundamentals and focus on team building, business model building. If you can get to a profitable business margin, ROI model, I think that's where the focus should be. And so going back to first fundamentals to build strong foundation for your business. And has the market recovered? Markets always recover, right? 22 years, 9 cycles, right? So you can see, I think there's a cycle every 2 to 3 years. Sometimes it's bigger than others. Sometimes it's a small blip, but it always comes back. So the question is it 2 years? Is it 3 years? And so companies that are, founders, you're not building a startup for 1-2 years, right? You're building this for the next 10, 20, 30 years. And so I think use this time, this kind of pause in the market to allow you, to do the right thing. And so I am bullish. In fact, we want our funds to do more early stage investments because I think this is the right time to now, find those founders who has the patience and who's really focused on doing the right thing during this period.
Okay, we'll take an audience question, and this is specific to Singapore and fintech companies, but I will broaden it to just regulation in general in Southeast Asia. Do you see the regulations in this region being a little restrictive for startups to succeed?
No, on the contrary, I have become more positive. Why do I say this, right? So there are certain areas. So for number one, there's a lot of discussion about Web3. There's a lot of discussion about crypto. If you look on a global basis, Asia has the best neutral to positive regulation. By not regulating against, you're actually positive, right? Because there are countries that have said no, and the entire sector gets shut down. So in that sense, I think this is one area. The second area, Singapore is the first country to approve cell-based meat. First country globally for the alternative proteins segment. Not even the US, right? And so what Singapore has done is that it's put the burner behind big countries like the US to figure out should they move faster in terms of adopting or clarifying regulations with regards to new alternative proteins, right? Food, this is the whole food supply chain. So in that sense, around what we see as the next generation of new technology drivers, we are actually seeing an Asia that actually is more open. And by being more open, by even having neutral to positive tendency, right, regulation, it's great. And I'll just add another one. If any of you have been to the recent air show hosted in Singapore, you will see that even in that sense, adoption of whether it's sandbox or trial area for, say, the eVTOLs, right, or the electric vehicles that flies in the air, like those are very new, transportation mode. And the fact that you see whether it's Indonesia, Singapore, actually leaning forward for those type of adoption is another plus. So I wouldn't say regulation is restriction. The fact that GGV reopened our office in Southeast Asia in 2019 is because we see fundamental shift. And that fundamental shift is not just in talent, as I mentioned, or business models or market, but also the underlying regulation towards innovation has actually taken a step, pretty big step forward, not just on digitization, adopting of online technology, but really going into deep tech, smart tech going into the future.
You touched on crypto. How does GGV view the crypto frenzy in this part of the world?
So I think that like any new internet change, when PC, internet migrates to mobile internet, you always have a application, which is what we call a super app, right? Or this is where you attract a lot of attention, where you attract a lot of activities. And so in the PC to mobile migration, it's gaming, right? Like everybody started to get onto gaming, mobile phone, you buy a phone just to game. How smart is that, right? Today we buy a phone for work, right? So I think similarly, as the web goes from Web 2 to Web 3, crypto is the first manifestation. And it's not even a short-term manifestation, right? It's been a 10-year journey, to be fair. And so what that has done is it has over the years attracted different types of players. The first few years, I think, would be there are definitely a lot of scammers in the mix, in any new markets. But I think over the last couple of years, we are seeing real technologists, people who have very strong technical background in traditional kind of PC or internet or mobile internet infra layer of talent actually come and address new issues and new applications. And so rather than say it's crypto, I would say crypto is the first manifestation of a Web3. Where we are bullish is where Web3 is going. And I think Web3 is a very broad word. It will cover areas like metaverse, which will touch on entertainment as a first cut. Maybe other areas like, finance, right, where they talk about DeFi or NFTs. So new way, but fundamentally the Web3 is about consumer and enterprise wanting power back to themselves, right? We went from a world that's very, decentralized and centralized always goes in cycles, right? So right now we are in a world that's very centralized. Many of our data is controlled by the likes of Amazon, by Facebook, by Google of the world, China, Alibaba, Tencent of the world. And it's a result of the last 10 years of technology innovation. And it has to be centralized because that's the only way that new services application can be created, right? Because there is a price, there is a cost to creating all these new services, right? And therefore, I think power goes to the big players, and in a way, they hold a very centralized position. But I think we are going into Web3 where the consumers are now starting to ask and say, why, right? Okay, my data is being leveraged. Why am I not getting a piece of the economic benefit? Why do I not have a say to how it's being used? And so I think it's a very natural evolution as well, that the next evolution we're going to see is that there will be a clamor, there will be a need to go more and more decentralized or actually power back to the consumer or to the enterprise. And so I think with that, for that wave to happen though, it will create a new opportunity for new startup. It means fundamental change in the technology stack, right? Is it more into the cloud? Is it more, into blockchain technology as a way to complement the multi-cloud? I think those are all big conversations that we can have, but it is happening because it's being driven by the end demand. Now, is it going to take us 5 years, 10 years to get to, say, today, the internet as we know it? It will take some time, but I think definitely as venture investors, we want to make sure that we are understanding this trend and reading this correctly so that we can find and invest in the right companies for our investors.
So plenty to remain optimistic about.
I think that's a wonderful thing about being a VC, right? We're not marked to market on a daily basis. I think we are being evaluated for how we envision the next 3, 5, 10 years is going to look like. And hopefully today we make the right bets in this emerging ideas, right? It could be ideas at this point. But yeah, I think that's what makes it fun. There's always something to be excited about.
Great. Thank you so much for talking to us, Jenny. That's all the time we have, but appreciate your insights. Thank you.
Great. Thank you. Great day. Bye.